Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
Eric, we try and do the global story of ETFs on Trillions. A lot of the times we're pretty U.S.-centric on that. I know we've done India recently. And then there was this headline that moved from Bloomberg News recently about Cathie Wood acquiring Rize ETF and making a play for Europe. And Europe is actually like a quiet ETF market. And that made me want to talk to you more about that and dedicate this episode to it.
Yeah, I've been to Europe a couple times as an ETF analyst and visiting clients there, and it's a really different market. We cover it on my team, and like I said, some of the stuff over there is a little different than the U.S., and it's interesting. But many of the issuers like BlackRock and Vanguard and Invesco and JP Morgan are all trying to sell their stuff over there. And it's interesting with ARK, right? Because now you've got a thematic issuer actually moving over there. Cathie Wood was interviewed and said that she found that 25% of the downloads from her research were in Europe. And that was what sparked her to move over there. And so it's an interesting time to cover that area. They've got about $1.5 trillion in assets over there. So it's, a fraction of the U.S., but it's growing, I believe, on a percentage basis slightly faster than the U.S. And so also in Europe, you can charge higher fees. And so a lot of the issuers here are getting Vanguarded to death. And so over in Europe, even though Vanguard exists, it's not quite as intense in the cost obsession. So from a revenue point of view, I could totally see the drive to go over there. But there's all kinds of like acronyms over there, like UCITS and MiFIDs and regulations. And I think it's interesting to get into the differences between that continent and us and, what works over there and what doesn't.
And to help us navigate what it all looks like, Hector McNeil, who's the co-CEO, owner, and founder of HANetf. This time on Trillions, what's going on in Europe? Hector, welcome to Trillions.
Hey guys, how are you doing?
Good, thanks. Hey, so Eric thinks you're like Mr. Europe for ETFs, and he's like he thinks of himself as like Mr. America. So how does Mr. Europe feel about Mr. America?
Well, there you go. It sounds like a couple of superheroes meeting each other, doesn't it? But I think if people saw us, they know that was far away from the truth. But no, certainly, I think when you say things like that, it just means I'm old and I've been around for a long time. But certainly. I've been here, and I'd think you would say I've seen it, done it, pinched it, spent it. So for sure, that's for sure.
Well, let me say why I thought that is that Hector isn't just an ETF issuer; he's a white label issuer. So if you're in Europe or even in US and you want to launch an ETF in Europe, you may go to him just to get the lay of the land. So he has all the answers, and that's what he's used to doing. And so that is an interesting perch. And so before we get into your perch there. Tell us a little bit of how you got there. What was your road to become a white label issuer?
Yeah, it's pretty interesting, really. I've been involved in ETFs pretty much since the start, late 90s in Europe. And I first got involved by setting up Susquehanna's ETF business in Europe. So I was there nearly just under 5 years. And then I left there and went to be one of the founders and owners of ETF Securities. So I was co-CEO there and co-founder with my buddy now, Nick, and Han stands for Hector and Nick. So while we were at ETF Securities, we invented gold ETFs, created the first gold ETF in the world in Australia, brought it to London. Then a couple of years later, we helped the World Gold Council create the GLD. So sometimes Europe is ahead, of the US and get there before them. And then we created a business called Boost, Nick and I, which was a short leverage provider similar to Direction Pro Shares that ultimately got bought out by WisdomTree, which we then set up WisdomTree's business in Europe. Again, we were co-CEOs, co-founders, and we co-owned WisdomTree Europe with WisdomTree, and then they bought us out. So Han's our fourth ETF business, fourth and last, I have to say. And in that time, we've issued just over 650 ETFs and ETPs, which I think equates to about 8% of every ETF on the planet. So not by AUM, unfortunately, but by number of products. So we think we think that we know our stuff pretty well.
So perception though is that Europe is a ways behind in the ETF market. How true is that perception, and how big is an opportunity when you see somebody like Cathie Wood make an acquisition like this?
Yeah, I think it's fair. I often say we're 3 to 5 years behind, but on a very similar, if not faster, trajectory. Europe's 30 countries, its population is double the size of the US, similar wealth demographic, and we're just really a little bit behind, to the point where actually when we decided to set up HANetf 4 or 5 years ago, the AUM in Europe is where the today is where the AUM in the US was at the time, right? So that sort of almost proves that we are 4 to 5 years behind. I mean, as I say, there is some innovation in Europe that's a little bit ahead of the US. You know, we have spot crypto products already in Europe. It does make us laugh when you guys say the world doesn't have a spot Bitcoin product, and we think, well, we've had that for a few years now. You know, and then ESG as well. You know, we think we're ahead of you guys to a certain extent on that. A lot of things you guys are litigating and fighting about, you know, we've decided on and moved on now, really, and it's become a just part of the mix. I think the Cathie Wood scenario is really, really interesting. She really is going to stir it all up in Europe. I mean, you're probably well aware that the Europe is pretty much an active market, probably bigger from an active basis than the US. You know, when you look at the full, you know, suite of mutual funds and such like, but it hasn't really hit the tape yet on the ETF world. We've got some on the fixed income side that PIMCO did several years ago, but it's not really being a thing on the equity side. But I do believe she's going to shake everything up with that, because I think she's the first sort of superstar, you know, active manager in the ETF space, you know, both in the US and she will be in Europe. And the retail guys know her name as well. And, you know, with the embeddedness of that retail demand, I think she's going to really, really shake it up. So I'm really quite excited. I think it'll see a lot of people come to the table. And actually, to be fair, we've probably had about, you know, over 20 inquiries, you know, that people have been talking to post the announcement with Rize. So we're pretty excited about it, to be honest.
Yeah, no, it's interesting. Back to sort of the Europe being behind. So I did deep research on a recent book called The Bogle Effect, which, if anybody's interested, shameless plug. But in that book, I looked at the spread of sort of ETFs and passive and low cost across the world, and it spreads faster in some places versus others. I kind of concluded that you kind of need two things for ETFs, at least, you know, the traditional beta type ETFs to spread. You need advisors that are fiduciary and get paid as a percentage of assets versus a kickback from the mutual fund. And you need a population that doesn't think its government is going to cover it for retirement. And so in America, we have both in spades. It's big time fee-based advisors. They're 75% of the ETF owners, really. And of course, everybody in America doesn't think they're going to get Social Security or anything. So they're a little more savvy. So thus they sort of shop better for their financial situation and investments. Can you take that and sort of give me the take what it's like in Europe on those two fronts?
Yeah, well, I think you know what you've got to realize with Europe is it's 30 plus countries, you know, with different currencies, cultures, exchanges, settlement systems. The whole shooting match, right? So you've got varying degrees of good climates for what you've just talked about, you know, from, you know, quite socialist, countries with strong social infrastructure, you know, through to a little bit more entrepreneurial, a little bit more capitalist. But I think where you do see ETFs strongest in Europe pretty much is, I would say, the UK, Germany, you know, Italy, with the second tier being Switzerland, France. But equally, you know, you are seeing some pretty interesting, moves in the Nordics and Benelux. But there are varying degrees of penetration. I think one interesting thing is happening in Germany at the moment, which is akin to what you're talking about. There's been a massive growth of savings plans with the big robo-advisors and the big banks, online brokerage platforms. And these essentially once a month investments, and essentially they're almost being completely dominated by ETFs now. You know, and they're very tax advantageous as well. So that's a bit of a revolution that didn't exist before, that is actually making people think long and hard, both with the ETF wrapper and also the model portfolios that back that up. I mean, we did something really interesting as well, which I'd just like to chuck in there that, you know, just shows the stage of it, that we cross-listed the first gold product into Poland 2 weeks ago, end of August. And I think we're the 11th product there, of which we're the only foreign issuer of gold products. You know, Poland's 40 million people. You know, it's a bit as big as Canada, right? You know, so you know that's an example of a market that's in very early days, but you can see over time it will get adopted and we'll get part of it, to the point where I was saying you got, you know, pretty mature markets like Germany and the UK. That's why I think you really need somebody who knows what's going on the ground. I always say that, you know, when US issuers come to Europe, they don't know what they don't know. And I think it often means that they take 2 to 3 years to figure out what they should have got right in the first place, but got wrong. But it's pretty hard to model that and pretty hard to tell people that.
So if you said Europe's 4 to 5 years behind, I'm curious though, because you've also hinted that there are things like crypto that you're ahead on. Are there things that the U.S. market and American issuers might be able to learn more from Europe?
Yeah, I think there's always things people can learn from each other, right? I mean, there's a lot of smart people, in both places. And, I just think that ultimately, you had a great tax advantage, which, speeded up the adoption. I mean, I always say, ETFs are just a wrapper, they're not an asset class or a certain type of investment. They're just a way to do a delivery mechanism to give a payout to clients. And, it just makes, and it's not even new technology. I always use the analogy, it's like mobile phones and landlines when you describe mutual funds versus ETFs, but ultimately the technology will win the day. And I think that's essentially what we're seeing. And, and I do think, we do have areas we are, I think, ahead, and a lot of it's regulatory environment, the crypto side, in Germany in particular. They have, very, very benign crypto regulations. I mean, they made crypto official financial instruments in 2020. Then I think another side that I think, the US can learn quite heavily from the Europe is the use of share classes. We've used share classes pretty much since day one in Europe. I mean, obviously, Vanguard had its patent, which prevented that. But most ETFs in Europe will have multiple share classes, whether it's accumulating, distributing, whether it's currency hedged, whether it's, lower fees. I mean, you even have an unlisted share class ability in Europe now where you can basically blend the mutual fund with the ETF. You can have basically an invisible share class that nobody sees unless it's sold to them. So, but equally, I think where you guys, really knock spots of us is really on the retail side. I think the retail really underpins the ETF stories, ETF success points. And I think the barriers to entry are so significantly less in the US than they are in Europe, and hence why I think white labels are really important, because building the infrastructure in Europe to get across 30 countries probably is a 2 to 3 year journey, $5 to $10 million, and that's before you've even started making any money, right? So it's a big decision, and then you've got to go against the behemoths like Vanguard and Amundi and BlackRock, so it's a big decision for a lot of people, but it's what ultimately everyone's going to have to take.
Talking a little more about that retail angle, I remember going over there, again, I've maybe been in Europe 3 times in the past 12 years. And what you'll hear is, it's really institutional over here, not a ton of retail. And I'm assuming that you put financial advisors in retail since they're managing retail money versus institutions would be like endowments, pensions, hedge funds, traders. When we look at that retail advisor market, what do you think is going to be key to penetrating it? Is it the plumbing? Or is it more the psychology of the investor there?
I think it's a mixture of everything, really. I think it's the broader adoption of the products. It's the products being more interesting than just being 5 basis points cheaper than the last guys, right? And that's where I think thematics make a lot of sense. I mean, just an example, we set up Sprot's uranium miners that they have in the US, URN, and we've got the same product now in Europe. Listed over a year ago, it's just popped 150 million, and that's been largely retail driven because it's a good story. People looking for that exposure, the press pick it up, the trade magazines, all those types of things. But I think the sweet spot currently is pretty much in the sort of wealth management, private banking space. And I think the sort of pure retail angle is picking up. And I think largely because we're starting to get our sort of challenger brokerage platforms now, similar to your Robinhood. We've got free trade, 212 trading, all these guys are offering free trading, fractional trading, things that weren't available until the last few years, and the technology wasn't there to do it. So I think that's been really important. I sort of expect the next stage of that will be, mass adoption of model portfolios as well. So, I think, again, that's just us catching up to you guys, I think, from that perspective. But it's that sort of ecosystem, as you say, that's really important.
You're totally describing something that seems like it's exactly 4 to 5 years old. One element that's also kind of interesting to me, though, is Eric polled ETF market share for Europe. And it's fascinating how similar the names are, right? You got iShares at number 1, you got Vanguard at number 4, you got Spider at number 6, but then there's like other names in here. And I'm just wondering from a competitive standpoint, you had mentioned Amundi before, they're number 2, X-Trackers at number 3, UBS at number 5. So there is a difference here, I guess, too, in just the number and types of players. So what is that? How's that unfolding, and how could this end up being a different sort of competition than the exact same players that are in the U.S.?
I think if we're brutally honest, I think the sort of bigger players have won the passive space, the cheap passive space. I don't think that's up for grabs anymore. So I think the sort of cheap S&P 500. I mean, we got this ridiculous scenario where there's 50 Eurostoxx 50 products in Europe. There's 40 S&P 500 products, and that's largely driven by every bank and major asset manager who's got a wealth management business needs those core products to to be competitive and to have that offering. And also you're talking about, as I mentioned before, 30 odd countries. So somebody might be strong in Switzerland, somebody might be strong in Germany, whatever it is. But obviously you've got those common players that are global players who will always be hoovering up that market share around the cost, the scale, those types of arguments. So I think this sort of next movement into the ETF 2.0 or 3.0, whether it's thematics, whether it's active, whether it's more IP driven good idea products. I mean, we did a product you guys don't have in the US yet, which I think is a real good example of something quite niche but pretty cool. We created a physically backed carbon credit product. Now, we did the first futures-backed carbon product back in 2007 at ETF Securities that's now owned by WisdomTree that was backed by Shell. But actually we did something 3 years ago with a company called Spark Change, ticker CO2, where we actually own the EUAs directly with the European Union. So we were, I think, one of the first financial companies that were allowed to do that. So rather than be non part of the physical story, because there's a finite supply. There's a bit like the Bitcoin and gold story. There's a finite supply of carbon credits. You as a personal investor now can own those, and effectively affect the demand supply side of that asset class. So I think that's where you can sort of muscle in and get a bit of airtime, next to these huge giants who otherwise, create a vacuum and hoover up all the space, and that's where you've got to do. You've got to be innovative, and you've got to just make sure that you've got strong enough elbows to make sure you're heard in that sort of scenario.
It's funny. So we have in the U.S. we have the 3 C's for ETF success: cheap, creative, or Cabernet. You're talking about the creative. You got to do something very different than beta, something innovative that can work. You can innovate your way to assets. The Cabernet is the old school. Let me wine and dine the advisors and brokers, hook them up, kiss their butt, give them golf balls. And there is a lane for that. It's shrinking, but it still exists here. But I think I wanted to, kind of jump on that a little bit with, I have seen a bifurcation in the U.S. forming. It used to be you'd buy like the Fidelity fund for your core retirement. But over the years, people replaced that with, as you said, cheap beta. But then they don't want to just have 3 funds that are sort of vanilla and boring. They want to add on top of that. So they look for things that are very different. I call it hot sauce. Carbon credits would be that. ARC would be that. Thematic ETFs would be that. Gold, crypto, all that stuff I think has a viable lane. It's not as big as the core of the portfolio, but 10, 15% of a lot of portfolios. So therefore, the client has a low-cost base and then adds on sort of to customize and scratch their FOMO itch. And in that way, they can participate and speculate. Like with uranium, that's a story they can participate in. So they're being active, but their portfolio is filled with things that are either cheap or shiny. Do you see that happening in Europe over the years? And that sort of old school mutual fund that's close to the index but charges 100 basis points kind of goes extinct?
Yeah, I think that's exactly what is happening. I have to say, I don't think it's happening quick enough. I do think the governments and regulators should be pushing that down the road. We all see those academic studies that show the degradation on long-term portfolios due to the fees, right? So if you're not adding any IP or any added value, you should go for as cheap as possible, as much scale as possible. So we're certainly seeing that where people are waking up to the fact that the classic old index trackers at 1% just make no sense to anybody. And I do think that what I always felt about, products with good IP and stuff that investors get their head around, they're all mini CIOs or investment managers, who want to feel that they've done their homework and got good ideas and, as you say, have a part of their portfolio that is a little bit more out there, a bit more spicy, as you say, that, is a bit more, effectively an active decision that they're putting into their portfolios. And, it also, obviously, I've always been a big believer in PR for ETF selling, and I think you can really reach retail pretty well and get that sort of point across where you do have a little bit of a differentiator, through PR. I mean, we have a great example of that with the raw mint gold product that we have. We use recycled gold within that. And recycled gold's 95% less carbon intensive than mine gold. It's the only one in the world that does that. Plus, we allow retail to have physical delivery of bars and coins if they want to swap their ETF for sovereigns and Britannias, with the Queen or the King's head on it, as I should say now. So, that resonates with people. And where that's cool is we actually put the price up on that product from 22 to 25 basis points. And out of the 600 products I've done in my career, I've never put the price of an ETF up ever. So I think that's a real good measure of where you can get your elbows out and get some space and show these guys you can add value to the space. And if you can get that message out through PR and on the wires or in the magazines, etc., I think it makes a massive difference.
All right, Hector. Last question is one we like to end with. What is your favorite ETF ticker other than any that you're affiliated with?
That's awful, because I think we've got the best ticker ever, Yoda, which is our start.
Oh man, you have Yoda? I saw that. There's another one over in Europe.
Yes,
Jedi. They got Jedi and Yoda in Europe, Magnus.
They stole it after us. They came after us, so we got Yoda, and then we've just done a defense ETF, which we've got NATO, which I really like NATO as well, which is pretty cool. But I think I actually, if I can go back to one that's not mine currently, which is with Elgin, but I did actually create it in the first place, which was 2 times leveraged FTSE, which is LUK2, LUK2, and then the 2 times short FTSE was SUK2, which I think LUK2 and SUK2 is pretty cool. They're good tickers. I like those.
All right, Hector McNeil, thanks so much for joining us on Trillions.
Thank you very much, guys. Appreciate it.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg Terminal, Bloomberg.com, Apple Podcasts, Spotify, or wherever else you'd like to listen. We'd love to hear from you. We're on Twitter. I'm at Joel Weber Show. He's at Eric Balchunas. This episode of Trillions was produced by Magnus Hendrickson. Bye.